I'm David McAlvany, the CEO of the McAlvany Financial Group, and I'd like to address the volatility in the precious metals market here in the month of June, along with volatility in the bond market, the dollar market, and the emerging markets, the equity markets, particularly in the emerging market space. I would also like to invite you to a live question and answer session tomorrow evening. That's Friday, June 21st at 6 p.m. Mountain Standard Time, 8 p.m. Eastern Standard Time, and the details are provided below. To set the context, the Fed decided to do nothing yesterday. Exactly nothing. If you listen carefully to the Fed's comments, it was quite ambiguous and deliberately ambiguous, in our opinion, stating that they would stay the course and continue to print, but if their economic objectives were met over the next 3 to 6 months, that they would then begin to taper or reduce the amount of purchases in both the mortgage-backed securities market and Treasury market. 3 words you might want to keep in mind as you're thinking about the Fed comments are these words: if, may, and assuming. Those are critical because when they look at their economic statistics, when they look at their economic models, they have, over the last 4 years, overestimated growth 4 years running. So 2013, why would it be any different? If they meet their objectives, then they will begin to pull back in terms of the money printing as well as the asset purchases, which are currently in play, the $85 billion, which everyone is very well aware of. While many of our investors are reasonably concerned with the volatility in the gold and silver market, far more important is the volatility that we're seeing in the Treasury market. Ordinarily, when you see a rout in the global equity space, the emerging markets, the Asian markets, the European markets, and the US markets, you see a significant shift into Treasuries, a rotation, if you will, from equities into bonds. We're not seeing that at all. In fact, we're seeing flight from bonds, again in response to this idea that the Fed may not have the back of the bond market. The Fed may not be the ultimate backstop for the Treasury market, and that has bond investors very, very concerned. Not just Treasury market investors, but high-yield bond investors and anyone with investments that are interest rate sensitive. The notion is that, yes, interest rates will be going up. Now, we do think the market is getting ahead of itself and reading into the Fed's comments, going back to that notion of they are assuming that the Fed's numbers are correct. They are assuming that the Fed's inflation statistics are accurate. They are assuming that growth dynamics are in fact in play, and we will see GDP outperform our expectations, beat our expectations, or at least meet the Fed's expectations. When in fact, again, just to remind you, 4 years running, the Fed has disappointed itself in overestimating growth and being disappointed at each turn. With that in mind, there's 2 variables which we should remember before we talk about gold and silver. One is the bounce in the dollar taking us back above the 200-day moving average, a very significant move in a 2-day period. In our view, not a sustainable move, but certainly for the next 3, 5, 7, even 10 days could be sort of a rally or attempted rally in the dollar space. That'll continue to keep pressure on the gold market. The second variable is inflation. The inflation statistic which the Fed uses and now which the general public is beginning to believe is accurate, which of course we would hold in high suspicion, is a number that's even more doctored than the CPI itself, something that doesn't really measure real-world inflation. So it's this number which is being assumed is benign. We hold that it is not benign. In fact, this is where inflation is being underestimated. Real-world inflation is going to come as a great surprise to those at the Fed, even though we on the ground would know it's a reality. And again, on that basis, who needs gold? If there is no inflation, if we do have growth in the economy, why do you need a hedge against a declining trend in terms of economic growth, a hedge against fiscal issues, a hedge against inflation, a hedge against, frankly, anything if we're in the context of recovery? So these are variables that I think you need to keep in mind and realize that they're not exactly well-grounded, and yet they are being acted upon in the marketplace. So to gold and silver. Gold broke support at 1340 last night. We suspected that it would hold, just like the 1530 number. We suspected that it would hold because it had held. The technical repair that has been done over the last 3 months has been undone and will have to be redone over the next 3 to 6 to 9 months. It is our view that that will be done. and this is a very temporary technical move lower. Technical move lower because none of the fundamentals have changed, which are very supportive of the gold market and its trajectory to significantly higher levels ultimately. The fundamentals, just to mention a few, of course, are the money printing, not just from the US, but Japan, Europe, and virtually every world central banker who's trying to foment recovery through the printing presses. In addition to that, you have zero rates of return or near zero rates of return in almost every geography around the world, in which case investors are frustrated and unable to have a positive real rate. That drives investment interest into gold. Investment interest into gold. On top of that, you have the normal supply and demand dynamics, the seasonal dynamics, which are very positive coming into the fall. And again, these are more cultural purchases that are made systematically through the fall and winter, specifically the Indian wedding season and the Chinese New Year. And finally, very supportive of gold at these levels is the fact the price is right on top of the cost of production. Your miners between 12 and 1500, the majority 12 to 1300 in terms of their cost to produce an ounce of gold, cannot stay in business if the price of gold goes any lower. So you have a basic economic floor put into the price at these numbers. Just as we saw in the April to May timeframe, COMEX inventories have continued to come down steadily. It's our view that this kind of sell-off in gold becomes very price attractive for those in the physical market who are still adding to positions. This includes India, this includes China, this includes sophisticated investors all over the world who do look beyond the shenanigans, the statistics fabricated by the Fed and the Bureau of Labor Statistics. This is where we think the major disconnect between the paper and the physical markets is going to emerge. Specifically, the paper markets being the futures contracts and options trades, which are leveraged in nature. This move lower in price may be the precipitating event to bring about the exhaustion of warehouse inventories on COMEX and ultimately a COMEX default. This becomes very interesting because this is the game changer in which the physical markets become more important than the paper markets. The paper markets have had the ability to bully price, not only in the April timeframe, but here again in the June timeframe. The physical markets have remained very strong, and this may be the final straw, again, which empties COMEX warehouses and brings us to paper default in the gold market. This is an age of insanity, and these market moves don't have to make sense. On Friday evening, we'll do our best to make sense of them in a more detailed format where you can ask any questions that you'd like, and we'll do our best to answer them as we can. It's important to realize that the bull market in gold is still intact, that the ultimate trajectory of higher prices is still in play, and that this, again, like the 74 to 76 period, while difficult to bear, will ultimately lead to a very, very different outcome. The things that have not changed, fiscal irresponsibility, money printing as a cure-all, these are things which we have to have in the rearview mirror, not in front of us. These are still our future, not our past. And until we have resolved massive monetary expansion, not only in the United States, but in Japan and in Europe, frankly throughout the world, we have not gone past the point where gold is relevant. Gold as an insurance policy within your portfolio has never been more important. The changes which are likely to take place between now and the end of the year, not only in the bond market, but also fragility in the global equities markets. If this route continues, you'll ultimately see a return to gold as people look and say, where else shall I go for safety? That safety bid is very close. Is it this month? Is it next month? We think we're very, very close. Where is the bottom? What is the bottom? That we don't know. The position that we've taken as a family is that we will hold fast. We're not making any changes to our portfolios. We see the bottom a lot closer than we do the ultimate end to this bull market at significantly higher prices. The difference in the price of the metals, both what we have still to give up and what we have still to gain over the next several years, will hold fast. We suggest you do the same. Join us on Friday for our Q&A. The details are provided below, and we look forward to entertaining your questions and having a conversation like we had 4 or 5 months ago with the same format.